because once you say digital currency, people say, oh, it's a cryptocurrency. And it's not a cryptocurrency for a couple of reasons. Number one, the whole notion of cryptocurrencies is that they're not issued by anybody. They exist. They can be created or mined or traded or whatever, but there's no central issuing authority that controls the supply. It's a kind of a community based algorithm. So that's one difference. The other difference is central bank digital currencies, at least as they've been announced so far, and a number of them are in existence, or at least 9 or 10 countries that already have them. I'll talk a little bit more about that, but they don't use the blockchain. Now, you could, but they don't. There are reasons for that, and we'll talk about that also. Blockchain technology by itself is nothing new. It's been around since the 80s. The way it was used in Bitcoin, for example, was an innovation, but the blockchain itself is not new. But central bank digital currencies do not use a blockchain. And the third thing, this again is source a lot of confusion. It's still the same old currency in a different form. So a central bank digital dollar is a dollar. Central bank digital yuan in China is a yuan. A central bank digital euro, or Aussie dollar for that matter, is a euro or an Aussie dollar. So it's not a new currency. It is a new payment channel. It is a new way to move the currency around. And as far as digital is concerned, I mean, the last paper treasury bond issue, I think it was 1979, 1980, thereabouts. I mean, so since I'll say 1980, the entire U.S. government securities market, a $25 trillion market with daily turnover in the trillions, has been digital, and the message traffic is encrypted. So if you want to say the dollar is a 40-year-old cryptocurrency, I guess you could. So it is digital. That's not really novel. Most of what we do is already digital, even without a central bank digital currency. If you think about your day-to-day life, you get paid, money's wired to your account, you've got bills to pay, you pay them online, use a credit card or a debit card or Venmo or Apple Pay or 100 different channels, et cetera, all of which is digital encrypted message traffic. So none of that is new. But the question is, what is new and why is it such a big deal? And I agree, it is a big deal. For one thing, the ledger, and ledger is bookkeeping, right? Like who owns it, who has it, I pay you, it comes out of my account, goes to your account, et cetera. The ledger would be maintained either by the central bank itself or finance ministry or some authorized clearinghouse, but authorized by the government. So it's not that's another difference with the blockchain. The blockchain's there. You can go look at it. All this stuff, anonymity is a little overblown. Private, not just private, but government investigators, FBI, intelligence communities love the blockchain because they can deconstruct every transfer that ever happened. Now, finding the name of the person, that's more difficult, and that's a forensic exercise. But once you do, you got everything that person ever did, all kind of laid out for you. So, but this ledger would be maintained by, well, let's just say the central bank, but it could be some authorized agent. So what's I'll just spend a minute on the case for central bank digital currencies. Why do they say they're a good thing? And it kind of goes, I can illustrate this with a very simple example. So let's say I'm in an airport, I go to a newsstand, I buy a book, and I pay for it with my credit card. So I get the book and the merchant brings it up on the credit card. Well, what does the merchant do with that receivable? Well, there's a finance intermediary out there. They're called merchant acquirers. And what they do is they buy these receivables from, it could be thousands or more of retailers. They pay the retailer the money and then they own that receivable. They then bundle them in large amounts and they deliver them to MasterCard or Visa, who are the issuers of the credit cards. And then, should say the sponsors of the credit cards. So MasterCard then pays the merchant acquirer. So what does MasterCard do? Well, they then take these receivables and they deliver them to the banks that issue the credit cards, and there are thousands of banks, and all those banks pay MasterCard. And then step 5, the bank sends me a bill and I pay the bill. But think about that. You've got the customer the retailer, the merchant acquirer, MasterCard, Visa, and the bank. You've got 5 intermediaries charging between 2 and 3%, close to 3% fees in a very clunky, multi-tiered, redundant and expensive and slow payment process. What if we had a central bank digital currency and I actually had an account at the Fed on my iPhone or your Samsung or whatever device you use, and so did you, and I wanted to pay you. It's like Venmo. I send it and it shows up, but it just goes through the Fed. The Fed debits my account, credits your account, done. No intermediaries, no merchant acquirers, no credit cards, no banks, and no fees. So they would say it's better, faster, cheaper. Now, I've raised the question in the past, couldn't you intermediate the entire commercial banking sector if you did this? I mean, who needs banks anymore? And the answer is theoretically you could. That won't happen because people lose sight of the fact that central banks, say, what do central banks actually do? They say, well, they're there to control inflation and stimulate the economy and create jobs. And now they're supposed to be the police for the Green New Scam, make sure nobody lends money to an oil company, et cetera. And they do all those things, but the real purpose is to bail out banks. Bankers are dumb. They screw up the entire world every 10 years on a pretty regular basis. And after Pierpont Morgan died, they said, who else is going to bail us out? Well, we'll create a central bank. At least that's how it played out in the United States. So, since central banks' real job is to bail out banks, they're not going to destroy banks. However, this whole business could go away. It could be greatly simplified. So they would say, again, easier, faster, cheaper, safer. What's not to like? There's a lot not to like, but we'll get to that next. But that's kind of the idea. Now, there's a corollary to this. Before I kind of continue the conversation on central bank digital currencies, there's a corollary, which is if you don't like central bank digital currencies and what they can do with them, okay, you can always go to cash. Just get out of the bank and get whatever, $5,000, $100,000 in cash or however much you like. Easier said than done, by the way. It's perfectly legal. I'm not talking about money laundering or anything illegal. To say, hey, it's my money, give it to me in the form of cash, at least in the United States. I guess it's the same in Australia. They'll look at you funny. They'll tell you to come back, make an appointment and come back because they don't have that much cash on hand. You'll have to bring, probably multiple character witnesses and your birth certificate and who knows what else in order to get the money. And then, at least again, in the United States, they send a report called a currency transaction report to an organization called the Financial Crimes Enforcement Network, or FinCEN. Notice the word crime right in the middle, and you'll go in a file next to like Ayman al-Zawahiri. So that's not as practical as it sounds, but at least it's theoretically possible. So they have to get rid of cash. In other words, allowing alternatives to the digital payment system kind of defeats the purpose of the digital payment system. Again, I'll come back to the nefarious and hidden purposes, or not so hidden. So they have to get rid of cash also. So the whole move towards central bank digital currencies, which has got ahead of steam, is running in parallel with the elimination of cash. So don't lose sight of that, because there's a very strong movement around the world, of which Australia is a part, the United States is certainly a part, to eliminate cash. In the U.S., we have a $100 bill. That's our largest denomination. When I was a teenager, the U.S. had a $500 bill, and they were in circulation. You could get them. So they eliminated that in 1968. No more $500 bill, and from then on, the $100 bill was the largest denomination. But the difference between then and now is that in 1968, a $100 bill was worth $100. If you adjust for inflation, the $100 bill of 1968 is worth about $20 in purchasing power in today's money. So we're already at a point where our largest denomination is worth $20 in purchasing power, at least compared to the 60s, $100 nominally, but it's greatly shrunk. So we don't have much cash. And by the way, if you want $1 million in $100 bills, that's 10,000 bills. It weighs exactly 22 pounds, and it fits in an attaché case, $1 million in $100 bills. people look at me funny. They go, Jim, how come you know that? Well, first of all, I do know that, but it's really just a math problem because one bill, whether it's a one or 100, but I'm using hundreds because the biggest weighs a gram. So it's basically, uh, 10 grams or, 10 kilograms, 10 kilos or 22.2 pounds. So, but that's, the point being, we're very far down the road to get them into cash anyway, but you can still do it. You can get your 22 pounds and have your $1 million in cash. So why are they so driven to eliminate cash? What's they got to do with central bank digital currency? Well, now we get into the purpose of the central bank digital currency. And the metaphor I've used is that if you want to slaughter pigs, you have to get all the pigs into a cattle chute and run them into the slaughterhouse and then slaughter them. You can't just let them, run around. You got to herd them up and get them into a cattle chute, or cows for that matter. And so if they want to slaughter savers and investors, they have to get you into a digital slaughterhouse. And that's what digital money is all about. If you can't have cash and you can only have the central bank digital currency, then everyone's got to have a digital account. And once they've got you in the system, of course, they know who you are because it's all digital and they keep the ledger back to the ledger. Because